Ever checked your bank balance and thought that can't be right? You're not going mad, and there's actually a proper accounting process to sort it out. It's called bank reconciliation, and it's basically double-checking that your records match the bank's records. Think of it like comparing your shopping receipt with your bank statement. You want to make sure everything adds up. Here's how it works. You start with your cash book balance. That's what you think you should have. Then you compare it with your bank statement. 9 times out of 10, they won't match, and that's completely normal. The most common differences? Checks you've written that haven't been cashed yet, deposits that are still processing, or bank charges you forgot about. Sometimes it's just timing. You recorded something on Tuesday, but the bank processed it on Wednesday. The process is straightforward. Take your book balance, add any deposits the bank recorded that you missed, subtract any payments they've processed that you haven't noted, and adjust for any bank fees. When you're done, both sides should match. Let's see a quick example. Suppose your cash book says you have $1,000. Your bank statement shows $950. You find a $100 deposit you made yesterday that's not on the bank statement yet, and a $50 bank fee you forgot to record. So you add the $100 deposit to the bank statement and subtract the $50 fee from your cash book. Now, both balances match at $1,000. That's bank reconciliation in action. Why does this matter? Because in the real world, businesses do this monthly to catch errors, prevent fraud, and keep accurate records. Master this now, and you'll have a skill that every employer values: the ability to spot discrepancies and solve problems methodically.